On May 15th, we revised Italy's outlook to negative on BBB+ investment grade ratings. In this regard, we expect Italy's debt level to be increasing significantly in 2020 to above 155% of GDP, with the risk being for a figure that's higher than that. That's from a starting point, notably, of 135% as of 2019. As a result, the debt sustainability challenges that the government faces are becoming more demanding. Italy has the second highest debt ratio of member states of the euro area, and the highest in the euro area when we consider only debt that needs to be repaid to the private sector, which is the segment of debt that Scope's sovereign ratings are assigned to. It's not only that debt is higher in 2020, but that we consider the likelihood of reversibility of high debt as being comparatively unlikely. That's in recognition of structural limitations such as weak nominal growth and inadequate fiscal consolidation during previous periods of economic recovery. Here, it's important to note that the European Recovery Fund that's being negotiated, which is a crucial step in the direction of fiscal integration in Europe, certainly is helpful. But even its substantial size may not be a game changer alone, and economic benefits are likely to be gradual.
In view of Italy's high public debt and government gross financing needs expected to be above 25% of GDP per year over the medium term, we consider a more permanent role of the ECB as likely to be needed to ensure continuous rollover of debt at sustainable rates. As shown in this diagram, the ECB and the Bank of Italy will own in aggregate well over 20% of Italian debt by year-end, with this figure increasing, so curtailing the share of Italian debt held by, for instance, other domestic institutions. This has both ensured manageable financing rates for Italy and the continued transfer of a significant share of Italian debt to the central bank balance sheet, which we consider as credit positive. So, this ECB and EU extraordinary support, we believed, has slowed the deterioration in Italy's creditworthiness, despite the very obvious and significant increase in gross debt levels. The only question is, will markets adapt and continue to finance higher Italian debt as long as contingent ECB support remains in the backdrop? Last month's BTP Italia issue, raising over 22 billion euros, is a good signal. At the same time, long-term debt sustainability remains very challenging.